Check out our most recent market update to find out what the THOR indicators are saying today. Good morning. I hope everyone is doing fantastic today. Well, we finished the quarter and I'm going to give you an update on what the THOR indicators are telling us. Keep in mind, THOR is not a market timer. What we are is a long-term tactical allocators. We don't just keep our asset mix and our style mix the same. We will move into more attractive areas and take money away from less attractive areas. So let's look at the THORdex. The THORdex is a measure of U.S. large company stocks. And so we're looking at here is the THORdex is at 76. So it is still elevated. So when people say is the market expensive, I always ask, well, what market are you talking about? If you're talking about U.S. large companies, yes, they are expensive. And it's why we are underweight U.S. large company stocks in a very meaningful way. At 76, what that is telling us historically, when we've been at this level, the return for the stock market has been under 6% annually over the next 10 years. So it is saying that there's high risk in U.S. large company stocks. But if you look at our videos, that's not an area that we are in, but we're in other areas that are cheap. So as I said, which part of the market are you talking about? You're right, U.S. large companies are expensive, so we are underweight equities in general. So next on the fixed income side, we look at fixed income side from two perspectives. We go from a -3, which is bad, to a +3, which is good. Credit. Basically, you're lending money to an institution, a company. Will it be able to pay you back or not? So credit right now is one of the lowest. So what it did actually a couple months ago go to -3. It's a -2.6 right now. Duration, which is, am I going to own a 1-year bond, which is low duration, or high duration, which is like a 20 or 30-year bond? Duration is positive. It's a positive 2.6. We go back to the beginning of 2022. This was a negative, almost a -3. Anyone that was buying longer term bonds when we had interest rates at 0 should have had their head examined. Now you're actually getting paid to do duration. And I'm going to show these two indicators in a chart at the end of this video, which I think is very demonstrative on what is happening with credit and duration. Next is we look at different styles. Because we're underweight equities, we have an overweight to alternatives. And these alternatives, if you go back and look at our videos in the last 2 years, you've heard us talk about gold mining stocks. We consider that an alternative investment because it is, even though they're equities, it's very specific going to gold, which is a commodity. And those areas and alternatives have actually done very, very well, much better than the U.S. stock market, at least the alternatives that we're invested in. The next thing is you look at the different styles. We are underweight U.S. Stocks, especially U.S. large company stocks. Small company stocks are more attractive than large company stocks, but because U.S. stocks are expensive, especially large company, we are underweight U.S. stocks in general, especially U.S. large company. We are overweight emerging markets and international. Here again, which market are you talking about? Alternatives have outperformed the U.S. stock market this year, as well as emerging markets and international have done 2 to 3 times better than the U.S. stock market. So being overweight in that sector, which we've talked about in our market updates, is an area that has performed very, very well. Notice on the right, there's one area that's called BDCs, and this is a good measure of private credit risk. BDCs are business development corporations. They were set up in the 80s to lend money to mid-sized businesses. So they're publicly traded entities, and they are lending money to these mid-sized businesses. Private credit is a hot area in the market. Everybody and their brothers coming out with a new private credit fund. It's great as all money's coming in, but the problem with private credit is that there's really no liquidity on trying to sell these mid-sized loans. No one's going to buy it from you. So if money starts coming out of that space, that's very, very bad. And we're seeing that performance. I mentioned, this is a credit indicator, and BDCs have actually, they were in the basement. They moved up a little bit. Why? Because they've underperformed. We still find them unattractive, but I could see buying into that as money comes out of that space. BDCs will become more and more attractive to us, and it's something that we were looking at to get into. Once again, like we did over the last 8 years. We got in 3 or 4 times in the BDCs. When they get attractive, we'll look at that. But look at this chart here. This is a good indicator of credit and also duration. You're looking at the ETF, the 7 to 10 year treasuries, which is longer term. Look at the performance so far year to date. You're looking at, they're up 8.5%. Those BDCs, which are lending money, taking credit risk, are down 8.4%. So once again, is the market expensive? Well, at the beginning of the year, we were saying BDCs we don't like. So you had the money in BDCs, it hurt you. Longer term investments were the right place to be, and our indicators are still telling us that is the right place to be. If you have any questions or concerns or need help with your portfolio, reach out to us at THORwealthmanagement.com or give us a call. Take care and talk to you in a couple weeks. Subscribe to the THOR channel today.